My name is Jim Holder. I am a co-founder and managing director with Waypoint Private Capital. We are an investment banking firm that helps business owners and their management teams sell their company. Today, I want to talk to you about preparing for financial due diligence in a sale transaction. We had talked to you in previous videos about the sell side process and had given you an overview of the entire process. Due diligence performed by the buyer is an integral component of getting to a transaction close. Due diligence begins once the seller, with our assistance, has selected a prospective buyer with whom they want to negotiate a final transaction. This occurs only after we have requested and received final letters of intent and have discussed the key elements of the buyer's offer so that we and our client understand the specifics of the offer. Now, we look at due diligence in two key buckets: financial due diligence and non-financial due diligence. This video will focus on the specifics of preparing for financial due diligence. The focus of financial due diligence will be to verify the financial data that form the basis for the buyer's offer. Most often, the offer for the buyer contains a purchase price that is based on a multiple of historical earnings before interest, taxes, and depreciation, most commonly known as EBITDA. Financial due diligence is usually performed by a third party who acts as a representative of the buyer. This representative is usually a CPA firm or other skilled financial services firm that has significant experience in a specialized area of mergers and acquisitions. Now, when a buyer engages a due diligence firm, they usually request what's called a quality of earnings report, or Q of E. The primary objective in a Q of E report is to provide the buyer assurance that the financial data is accurate and has been prepared in accordance with generally accepted accounting principles, more commonly known as GAAP. In a vast majority of engagements, financial due diligence occurs prior to non-financial due diligence, so that the buyer and the seller can gain comfort prior to expending additional time and money on the non-financial due diligence item. This also helps spread the workload out for the seller's management team and accounting staff. Once the work begins, one of our objectives as the investment banking firm is to ensure that both due diligence teams stay focused on the Q of E goal and don't get sidetracked with issues that are not relevant. Now, let's get into some of the more specific items in preparing for financial due diligence. As a rule of thumb, buyers will want to evaluate 3 years of historical financial statements and will request that information in electronic form to speed up the process and eliminate unnecessary duplication of effort. So keep that in mind, that whenever you can save the data in electronic format, greatly reduces the workload for everybody. Generally speaking, the buyer's due diligence team will request information in the following areas for each of the prior 3 years. Sometimes they may want more, sometimes less, but typically 3 is a good rule of thumb. They will ask for detailed income statements and detailed balance sheets, detailed general ledgers that support the financial statement, detailed listings of inventory and fixed assets, listings of patents and other intellectual properties and the supporting documentation for those assets, detailed payroll records by employee, including annual calculations for bonuses and any documents that support the bonus plan themselves, historical sales by major customers and by product or service type, historical purchases by major vendors and by items purchased or services purchased, detailed aged accounts receivable and detailed aged accounts payable by customer and vendor, respectively. The due diligence team will perform detailed testing in the areas of cutoff for revenue and expense items, proper accrual of all material liabilities, and analyses of product margins and service margin. They will also do other work as they deem important. The list of items that I just mentioned can also grow, and usually does. But what is most important to note in this list is that the items must be worked on as soon as possible in beginning to prepare for the financial due diligence. Our experience is that those who prepare early have the best results. Buyers will also require monthly financial statements for at least the previous 12 months, as well as the months in the current year. These financials help the buyer analyze trends in monthly activity, as well as in seasonality or cyclicality within the seller's more recent business. The accuracy of the monthly financial statements is one of the most overlooked areas by a seller when they prepare for a sale transaction, and it is one of the most important areas in the due diligence process. The buyer's diligence team requires accurate monthly and annual financial data to complete their analysis and their recommendations to the buyer. So this is a vitally important area. The monthly financial statements also provide a basis for determining the normal level of working capital that will be required at close. Within the financial due diligence process, this is an important and challenging area of analysis and discussion, one that has a direct impact on the amount of cash the seller receives at close. In preparing for financial due diligence, we set up a regular meeting schedule to monitor progress and provide support to management and the accounting staff. During this phase, we pay close attention to requests that are onerous or unnecessary. Additionally, we make it a point to stay in close contact with the buyer's diligence team and understand how they're doing in their process. Once we and the seller's team begin to accumulate the requested data, we will set up an electronic data room where all of the files are stored and can be reviewed as needed. When we and the seller are comfortable with the data, it is moved to a third-party data room that we manage and that is highly secure and allows us and our client to track exactly who visits the data room by invitation and what they view and download. In any sale transaction, financial due diligence is an extremely important element of moving toward a close, as the investment banker will be the leader of your team. The process generally takes 3 to 4 weeks, depending on everyone's schedule and availability. We hope you found this video to be helpful in explaining some of the details about how a seller should prepare for due diligence in a sale transaction. Please call us if you have additional questions, or you can go to our Insights blog section on our website. Thank you.